Yeah, Shruti, can you see my screen? Yeah. Okay, let's go. So starting off, guys, next we're looking into the next set of topics here, and this is chapter 9. So let's get a good simplistic understanding about this particular chapter. And let's look into the questions of this once we are done with this. So first we look into the objectives of account receivables management. Why do we need to do a receivables management? What benefit it will bring to us? Okay. So how much credit should we give to customers? So what is the objective of account receivable management is how much credit should we give to our customers? Okay. How much credit should we give to our customers? We have to ensure that we have a good amount of credit that we are giving, not too much, not too less, so that our business can also prosper and customers also stay with us. They don't go off to other people. Okay. How much credit should we give to customers? That is the objective of receivable management. That how much credit should we give to our customers? So we have to balance it. If we give too much also, there's a problem because then we will not have any money. We'll have to borrow from the bank. If we have given too much also, it's a problem. If we have given too less, then customers won't come to us. Right? If we give too less, then customers won't come to us. They will go to someone else. Right? So they have to keep a balance between profitability and liquidity. If you give too much, then you will not have liquidity. If you give too less, you will not have profitability. So you have to make sure that you manage in an optimal way so that you have profitability also and you have liquidity also. Okay, you manage it in such a way that you have profitability also, you have a liquidity also. Like you see here, if you have too much, if you give too much also, it's a problem. If you give too much, it's a problem. Now, maybe. हाँ हाँ if you have too much also, it's a problem. If you have too less also, it's a problem. Right? If you have too much, it's a problem. If you have too less also, it's a problem. Okay? Too much also is a problem. Too less also is a problem. If you have given too much credit, then liquidity will be a problem. If you have given too less credit, profitability will be a problem. Okay. So what you have to do is we look into the chapter now is that how you can do a very good balance of profitability and liquidity. First of all is the account receivable. First what you should do is establish a credit policy. First what you should do is establish a credit policy. First thing what you have to do is establish a credit policy. What do you mean by that? Okay, what is a credit policy? A credit policy basically means the rules the company sets for giving credit. You have to set some rules, right? You have to set some ground rules, right? Set some rules. What the management must establish is a credit policy. What is a credit policy? Set some rules. Okay, what you have to do is set some rules. Okay, for how much credit you will give, when you will give, who you will give. You have to make some rules. Okay, how much, when, and who. How much credit you will give, when you will give, who you will give. How much you will give, when you will give, who you will give. For this, you have to make some rules. That rules is called as a credit policy. Now, what are the 5 factors that influence your rules? Your rules should be affected by few things, right? What are the factors that affect your rules? Okay. What are the factors that should affect your rules? Okay, for account receivable, the company policy should be influenced by what? So, policy should be influenced by some things. Firstly, demand for products. Okay, firstly is the demand for products. Okay, if your demand is low, give more generous credit to boost the sales. Right? First of all, the focus is on demand. Okay. So first of all, see, first step is guys, when you go to do your receivables management, your first rule is to have a good credit policy. How do you ensure there's a good credit policy? You look into the factors that affect your credit policy. Firstly is the demand for the products. If your demand for the products is low, then you should give more and more generous credit policy. If your demand is low, give more generous policy. If your demand is high, don't give much generous. Keep it low, keep it strict. If your demand is high, you can keep it strict. If your demand is low, you have to give. If your demand is low, then you have to give. But if your demand is high, you can keep it strict. If your demand is high, then you can keep a strict policy. If your demand is low, then you need a tight policy. If your demand is low, then you need a generous policy. But if your demand is high, then you can keep a strict policy. Second, competitors' terms. Okay, match what the competitors offer. If they give you 30 days, you probably have two. So you have to see what your competitors are giving, right? If Zomato is giving too much credit policy and Swiggy is not giving, then all of us will go to Zomato. So you have to see what your creditors are also giving. If your creditors are giving a lot, then it's a problem. Okay, you have to see what your creditors are giving. You have to see competitors' terms, what your creditors are giving. Next, risk of irrecoverable debts. If the customers are risky, you have to be more strict. Okay, if customers are risky, then you have to be more strict, right? How risky are your customers? Right? Look into the background of your customers. How risky are they? Okay, look into the background of the customers. How risky are they? What is the risk of irrecoverable debts? If the risk is a lot, then also it's a problem. If its risk is a lot, right? If a very risky customer, don't give generous credit policy. Don't keep the rules very strict. If your customers are good and they are not much risk, then you can keep little generous. But if your customers are very high risk clients, don't keep very generous credit policy. You will be in a loss. Next, financing cost. You have to look into that if the borrowing is expensive. Like currently, I gave a lot of credit. I don't have any money. Then I have to borrow from the bank. If the borrowing is very expensive, then you don't give credit only. If borrowing is very expensive, give very less or don't give credit only. If borrowing is expensive, don't give credit only. Okay. If borrowings are very expensive, don't give credit. If borrowings are expensive, don't give a credit. Okay. If borrowing is expensive, don't give a credit. Okay, if borrowings are expensive, don't give a credit at all. If borrowings are expensive, don't give a credit at all. Okay, next, cost of credit control. Chasing debts, admin, bad debt recovery, cost company. Strict policy is low cost. See, cost of credit control. So when you give credit, then you need a team to manage that credit also. Simply you can't just give the credit and sit and yeah, they will pay. You need a team. They will keep chasing them. They'll keep asking for the payment. They'll keep following up. So you need a full team for that, right? So that all costs you money, right? Chasing debt, admin or bad debt recovery, all costs money, right? So you have to make sure you analyze what will be the cost of credit control. Okay. So first of all, you did a sale, you opened a business, you did a sale. That sale was on credit. So the moment you do a credit sale, there will be something called as a receivable because the customer will pay later. So there will be something called as a receivable. So what you have to do is lot then looking the fact that you're giving for free, lot of people will come. Right? Lot of give me also on credit. You don't have to pay today. You take it today, pay later. Anyone will come and take. So many people will come and take, and they are coming also. So you need to have strong rules. If you don't have strong rules, then you will be in a problem. So you need to have strong rules. What are the strong rules? Okay, what are the strong rules? Number one, you need to have strong rules. What are the strong rules? Number one, you have to see what are the demand for the products. If the demand is very high, you can be strict. If the demand is low, you have to be generous. Second, see what your competitors are doing. Third, see how risky the customer is. If the customer is very risky, don't give him much credit. If the customer is very risky, don't give him much credit. Next, financing cost. Next, financing cost. What about financing cost? Next is financing cost. If the money is very expensive to borrow from the bank, see, if you give credit, you will not have money. So how will you run your business? You'll have to borrow. And if the borrowing is very expensive, then it will be loss for you in the business. So if the borrowing is expensive, don't give much credit. Next, cost of credit control. That you see how much it will take you to control the credit. Like you'll need a team, sales team, admin team, you'll need a full team. So you have to see cost of credit control. Okay, what you have to do is see the cost, how much it will cost you, the cost of credit control. Okay, you have to look into the cost. What is the cost of credit control? You have to look into all these factors. Okay, when establishing a credit policy. When establishing a credit policy, you have to look into all these factors. When establishing a credit policy, you need to look into all these factors. When establishing a credit policy, you have to look into all these factors. So now you look into the credit policy has four aspects. In your credit policy, there has to be four aspects. What are the four aspects of credit policy? Right? What are the four aspects? In credit policy, there are four aspects. What are the four aspects of credit policy? Let's look into that. What are the four aspects of credit policy? Number one, assess the credit worthiness. So before giving credit, assess should you give credit or not. Right? Assess the credit worthiness. Check if your customer can pay. Before giving him money, check if your customer can pay. That is called credit worthiness assessment. Check if your customer can pay. That is called credit worthiness. Check if your customer can pay. That is called credit worthiness. Check if your customers can pay. Right? A firm should assess the credit worthiness of all the new customers you should check. And for existing customers, do it a periodical check. New customers immediately, existing customers periodically. Once in a while, you have to check for your for your existing customers also. Next, information may come from. Now, to know about the person, from where will you get the information? First, you can get from their bank reference. Next, you can get from a trade reference. You can get their information from competitors. You can get information about them from your published information in social media and wherever. Get information from credit reference agencies. You can get information from companies' sale record. You can get information from credit scoring. So you can get information from a lot of places. You can get information from a lot of places. Where can you get information? If I want to give, someone has come to ask for credit. So before giving him credit, I will check about him. That should I give him credit or should I not give him credit? So where will I get to know? I will get to know from bank reference. I will get to know from trade reference. I will get to know from competitors. I will get to know from published information. I will get to know from credit reference agencies. I will get to know from company sales records. I will get to know from credit scoring. From all these places, I will get to know about that customer. And after getting to know about that customer, I will decide should I give him money or should I not give him money? Sorry, should I give him credit or should I not give him credit? So from where will you know bank reference, trade reference? From competitors, from published information, from lot of credit reference agencies, from the company sales records, from credit scoring agencies. So from a lot of people, you'll get to know that should I give him money or should I not give him money? From a lot of agencies, you will get to know that should I give him money or should I not give him money? Okay, sorry, should I give him credit or should I not give him credit? So that is called as credit worthiness. That before giving credit, before giving credit, you should check should I give him credit? Okay, before giving credit, I should check should I give him credit? Okay, before giving credit, I should check should I give him credit or not? Okay, before giving credit, I should check should I give him credit? Okay, before giving credit, I should check should I give him credit? Very important. How will you check? For new customers immediately, existing customers periodically. How do you check? You look into bank reference, trade reference, from competitors, from published information, from credit reference agencies, from company sales records, from credit scoring. From all these companies, I need to look into that should I give credit or should I not give credit? Okay, for all new customers, I should give credit immediately. For existing customers, I should give credit periodically. From all new customers, I should give immediately. From existing customers, I should give periodically. Okay. From all new customers, I should give immediately. From existing customers, I should give periodically. I should do the credit check periodically. Now, where will I get the information from? Bank reference, trade reference, from competitors. From all these places, I'll get the information. After getting the information, I should think, should I give or should I not give? If I not give, don't give. If you can give, then you can give. So first you have to assess that should I give or not. That is called assessing the credit worthiness. Is he worthy of credit or not? Is he worthy of credit or not? Should I give him credit or not? Simple. Okay, that is the assessing the credit worthiness. Second thing in the credit policy, second thing is credit limits. How much to give to anybody? Credit limit set the maximum amount each customer can get. Credit limit says what maximum amount each customer can get. What is the maximum amount each customer can get? That is called credit limit. What is credit limit? How maximum amount that each customer can get. So what is credit limit? It should be set to reflect both the amount of credit available, that how much amount he can get, and for how long he can get. Right? Before he has to repay. For how much, that is how much money, and how long. How much and how long. That is called credit limits. Okay, that is called credit limit. How much and how long. How much and how long. That is called credit limits. How much and how long. How much can someone get credit? How long can someone get credit? Okay, so before you give someone credit, what do you mean by credit, buddy? Sharon?
So credit means like that loan, giving the loan.
Not taking money immediately, you letting them pay later also. Okay. Third one is invoice. Third one is invoice promptly. The moment you give them the goods, immediately you invoice. Why? Because the day you invoice, from that day credit period will start. Credit period will start from the day you deliver the goods to them. So immediately you should invoice. Do a prompt invoicing. Immediately invoice. Okay. Third one is immediately you should invoice. A credit period will only begin after an invoice is received. So prompt invoicing is essential. So immediately you should invoice. Promptly you should invoice. If the debts go overdue, then the risk of default increases. Okay. If the debts go overdue, then risk of default increases. Then the risk of default increases. Therefore, a system of follow-up is required. A system of follow-up is required. Okay, a credit policy only begins once the invoice is received. The moment the invoice is received, only then a credit policy begins. The moment an invoice is received, only then credit policy begins. So what you should do prompt invoicing. Immediately you should do invoicing. What you should do prompt invoicing. Immediately you should make an invoice and give. Immediately you should make an invoice and give. Okay, and if debts go overdue, the risk of default increases. If debts go overdue, then the risk of default increases. Therefore, a follow-up system should be there. So first of all, see, the moment you make a bill, from that day credit period will start. So immediately make a bill. The moment you make a bill, credit period will start from that day. Immediately make a bill. Yeah. The day you make a bill, credit period will start. Immediately make a bill. Okay. From the day you make a bill, credit period will start. So immediately you should make a bill. And if debt is going overdue, you need a good system. If debt go overdue, first what you will do, you will write letter to them. Please give my goods, please give me money, give my money, give my money, give my money. You will write letter. Next, you will call them, give my money, give my money, give my money. You will call them. Third, you will stop sending them more goods. You will withhold the supplies. Then also, if they're not paying, you will send debt collectors. Go and collect the money and come. I'll give you some money from that. Next, legal action. Go to court. First, you send a letter, then you call, then you withhold the supplies. Still, they are not giving money. You send debt collector to their house. Next, legal action you can take. Go to the court. So this is the follow-up system you need. If they don't pay you money, this is the follow-up. And finally, monitor the credit system. Finally, what you should do is monitor the credit system. That means do an aged analysis. That means 30 days someone has not paid, 30 days overdue. These 10 people have not paid from 30 days. 60 days overdue. These people have not paid 60 days. It's been overdue. They have not paid. 90 days overdue. 90 days over. These guys have not paid. So aged analysis you do. Calculate a lot of ratios. Okay. Calculate any ratios. Okay. Calculate any ratios. Okay. Calculate any ratios. Okay. Next is ratios. You have to calculate a lot of ratios. Next is ratios, right? And finally, look into statistical data, right? Do look into compare your ratios with previous period. Previous period you will see and to see how much your credit levels have increased. Are they more overdue or irrecoverable debts? Credit levels. Next, statistical data, right? Use statistical data to identify why is this happening? Why are people not paying you? And finally, you see age analysis that how long has it been that people have not paid you. So if you do these four systems, the four policies, if you follow these four steps, right, you will have a very good credit policy, right? So see, first of all, I have a business. So if I have a business, customer will come. If customer will come, some of them will want a credit purchase. They will want to do credit purchase. So I have to give them on credit. What do you mean by credit? I'll give them the goods now. Payment they will give after 1 or 2 months. Later they will pay. But now what happens is after 1 or 2 months, they will not pay only. They'll stop picking the call. They will not give me money. My money is gone. My goods is also gone. So to protect, so to protect us from that, okay. So to protect us from that, so to protect us from that, so to protect ourselves from that, okay, to protect ourselves from that, okay, to protect ourselves from that, what has happened is to protect ourselves from that, yeah, to protect ourselves from that, okay, so to protect ourselves from that, what we have to do is, yeah, iPhone वाला क्या? देखिए C type का या ये lightning. Okay, so let's assess the credit worthiness. So first of all, what we'll do is we'll assess the credit worthiness. What do you mean by credit worthiness? We will ensure, right? First, we'll assess the credit worthiness. We will see whether we should give them credit or not. Second, if we are giving them, how much to give and for how long to give. How much to give and for how long to give. That is credit limits. Third, immediately we should make a bill because the day you make the bill, that time credit period will start. So immediately make a bill. Next, monitor the system. Keep monitoring the system. How? Three ways. First, make an aged receivable analysis. How many people did not pay for 30 days? How many people did not pay for 60 days? How many people did not pay for 90 days? How many people did not pay for 120 days? How many people did not pay for 150 days? You do a proper analysis of that system, right? Do a proper analysis of the monitor the entire credit system. Monitor the entire credit system. Okay, monitor the entire credit system. Next, what you should do is monitor the entire credit system. And once that is done, how do you do? First, you do age analysis. How many people have not paid? Second, you will do statistical data. You look into why people are not paying. And then you will calculate ratios also. You will see what is the trend in the market. Is only in me or in the entire industry people have stopped paying on time or people are taking extra to pay. So these are the four ways how you can establish a good credit policy. What is a credit policy? Rules. If you give credit to customer, you have to make a rules around it. If you give credit to customer, you have to make a rule around it. Okay. If you make a credit to customer, you have to make a rule about it. Okay. Credit to customer, you have to make a rule about it. Okay. Credit to customer, you have to make a rule about it. So that rule is called as credit policy. And four aspects of that policy, we have looked into all the four aspects. Okay, now we have some calculations. Up till now, we understood credit policy. Okay, up till now, we have understood credit policy. Okay, so let's look into the first two things here. Angeline, how have you understood the first three things? Credit worthiness and credit limits in a generic way.
Yes, so credit worthiness, we have to assess the customers. If they are, we have to check if they're new customers, we have to, run a test on them. Or if they are existing customers, we can, review their, credit worthiness periodically. So information will get through bank reference, trade reference, competitors, published information, credit scoring, etc. And credit limits is the limit which the supplier sets for the customer based on each customer's profile.
Hmm. Okay, so based on customer's profile, you will set a limit, and limit basically means how much you will get, and also for how long you are available to get that limit. Okay, perfect. Shruti, let's look at the next two. What have you understood? What do you mean by invoice promptly? Why should you invoice promptly? Yeah, Shruti, are you there? Okay, let's look into the next two here as well. Anjali, next two, how have you understood?
Invoice prompt that is something where only if you're going to invoice immediately when the grace period is going to start. So we have to invoice it as soon as the sale period is done. And we have to check on the number of days. And based on that, we have to collect the overdue debts. We have to keep following up. Otherwise, there's a risk that we will lose the, money.
Okay.
And then monitoring the credit system, we have to, do the age analysis, statistical analysis, the ratios to check how long it is. Like how many days it is being pending that the customers given us money. We have to, the monitoring of the credit system.
Okay, perfect. So that is about this. So that is about the credit policy. Now we look into some calculations, some simple basic calculation, and let's get a strong understanding about that. Yes, firstly is finance cost. So if I have given receivables, that means I don't have money, right? I gave 10 crore goods to you. Okay, and I told you pay next year. So now for 1 year I don't have money. Why I don't have money? Because you didn't pay. Why do I don't have money? You did not pay. Why you did not pay? Because it was a credit sale. So in a credit sale, you can pay later. In a credit sale, you can pay later. So what you have done, you have paid later. So 1 year I don't have money. So how do I run my business? I have to borrow from the bank. If you had paid me, I would have money. But now you did not pay me. If you had paid me, I would have money. But did you pay me? No. So what I have to do? I have to go to the bank. And if I take from the bank, bank will charge interest. So how do you find finance cost? Finance cost is nothing but the receivable balance into interest rate. What is finance cost? Receivable balance into interest rate. Okay, and how do you find receivable balance in the first place? We just flip the formula. Which formula, Angeline? Do we remember the formula for receivable days? Receivables by credit sales into 365. Angeline, do you recollect? Angeline, can you hear me? Okay, let's get some network issues. Yeah, Shruti, can you hear me?
Yes, sir. Now I can hear.
Okay, Angeline, can you also hear me? Your mic is, you're unmuted. You're muted, Angeline, if it's telling me something. Okay, done. Maybe Angeline can't hear us right now. Okay, so that is finance cost. What is finance called? Receivable balance into interest rate. Receivable balance into interest rate. Okay, what is finance cost? Receivable balance into interest rate. What is finance cost? Receivable balance into interest rate. And what is receivable balance? Again, you just flip the formula. Revenue by credit sales, receivables by credit sales into 365, you used to get the receivable days. So now you just flip the period, you flip that formula, you will get the receivables. Let's look into this. You have a sales of 20 million. Receivables are 4 million. Okay. What is the cost? And the cost of financing is 12%. So first of all, calculate the period. Receivable days you calculate. Okay. 4 by 20 into 365 you do.
73.
73 days is the current receivables period. Second, receivable cost of financing. See, receivables 4 million into 12% you do.
That 4.
4 million into 12%.
4,80,000.
So let's look into this. Let's see if it's the same. Okay, are we getting these two answers? Yeah. Shruti, is it clear? How did we get both the answers?
Yes.
Okay. First is your receivable days, normal formula, and then your cost of financing. You just take 12% of the receivables. Next, we have early settlement discounts. Okay. So cash discounts are given to encourage early payment by customers. Okay. So cash discounts are given to encourage early payment by customers. To encourage early payment by customers, we give a cash discount. So the cost of the discounts is balanced with the savings the company makes to having less cash tied up. Okay. So now let's do a sum and then we'll make sense of it. A company is offering a cash discount of 2.5%. Okay, how much discount the company is offering? 2.5%. If they agree to pay within 1 month, the usual credit period is 3 months. If they pay within 1 month, the company will give a 2.5% discount. So, what is the effective annualized cost of offering the discount? If the bank would give the loan of 18%. So, see, if you borrow from the bank, it's 18%. If you give the cost, if you give a discount, so basically, see, I want you to pay early. I told you, when should you pay?
1 month before. Yes,
You will pay 10 crore, we had a sale, you will pay after 1 year. 10 crore, we had a sale, you will pay after 1 year. But I want you to pay early. So what am I giving you? I'm giving you a discount. 2.5% discount I'm giving you. How much is that discount costing me? First I have to check that. And if I don't give you a discount and if I borrow from the bank, how much is bank charging me? If giving you discount is cheaper, I'll give you discount. If giving you discount is more expensive, I'll borrow from the bank. So I have to see which is cheaper. Okay, so first I'll calculate what is the cost of discount. So there's a simple formula for calculating the cost of discount. So here is the formula. So you have to do 1 plus discount. So do this 1 plus 2.5. Do 1 plus 2.5 divided by 97.5.
Divided by 97.
Divided by 97.5. Amount left to pay is 97.5. If 2.5 is discount,
0.
1 plus 2.5 divided by 97.5. Okay.
2.5.
1 plus
Yes,
2.5 divided by 97.5. Okay. What did you get?
0.0256.
Okay. To the power of number of periods. Number of periods. So how much are you saving in the sense that before people used to give in 3 months. Now you're telling them they can give you in. If they how much when are you giving a discount? How early should they pay? If they pay you within 1 month. So how many months are you saving? 2. Right? So write 12 by 2. 6. Number of periods is 6. 12 by 2. Okay. So what answer you got? To the power of 6 you do. You now do to the power of 6.
Next.
Minus 1. See how much is it giving you?
0.1935.
Minus 0.16 or 19?
19.
Okay. 35. Just check here. 2.5 divided by 97.5. Are you getting 2.56? Okay. That is a percentage. So let's convert it into decimal. So you'll get 0.0256.
It's a 0.1935.
Okay. So minus 1 and you get 16.38. Okay, what are they getting here is 16.38. And 16.38 is less than 18%. Since 16 is less than 18, give a discount. Okay, so we'll go step by step. What did you do first? You wrote 1. 1 is easy. Then you wrote discount. How much is the discount?
Discount is 2.5.
2.5. So automatically left to pay would be 97.5. No,
Yes.
2.5, 97.5. Now, number of periods is the only difficult calculation. How do you get number of periods? Number of periods is 365, 52, or 12. If they've given you in years, you take 365. If they've given you weeks, take 52. If they've given you months, give 12. So here they are telling in the question that this guy is paying within 1 month. So they have given in months.
Yes.
And generally people pay within how much? 3 months.
3 months.
But they are giving you a discount if you pay within 1 month. So how many months are you saving? 2 months are you saving? If someone generally gives in 3 months, now you're telling them to give in 1 month. So 2 months worth credit you are reducing. 2 months you are saving. So what you do is you do 12 by 2. If it was given in weeks, you would have done 52 by 2. If it was given in years or days, you would have done 365 by 2. But because it's given in months, you're doing 12 by 2. This is how you get the period. This is the only calculation that makes this formula a little difficult. Nothing else. That how many periods are you saving? Right? Number of periods you are saving. How many periods are you saving? Okay, so number of days, weeks or earlier, the money is received. Number of days, number of weeks, number of months, the money is received. Okay, number of days, weeks, and months. Number of days, number of weeks, number of months that you're getting the money earlier. Okay, number of days, number of weeks, number of months that you're getting the money earlier. Okay, you get number of days, number of weeks, number of months that you're getting the money earlier. So you're getting 2 months earlier because generally you used to pay in 3. Now if they pay in 1, you'll get they'll get the discount. So 2 months you're saving. So 12 divided by 2. And then it's a straightforward formula. You see, discount to pay and amount left to pay is easy. Directly can calculate. Only the number of periods is something that you have to just remember over here. And how do you calculate? You just see, have they given months, days, or weeks divided by how much is being saved. That's all. Okay, minus 1, and you'll get 16.38. But the loan rate is 18%. So it's better to give the discount. Discount is only 16.38. Loan means 18%. Better to give the discount. Okay. Next, we'll look into early settlement in another way. One more early settlement we'll look into. Paisley Co. sales is 20 million. Okay. Receivables 4 million. Okay. The cost of financing the receivables, if you go for bank, 12%. It is now considering to give a cash flow of 2% within 10 days. Okay, within 10 days. Okay, within 10 days. If people pay within 10 days, we'll give them a discount. Okay, so first of all, you find out currently how long people are taking. Currently, how long people are taking, write down. 4 by 20 into 365.
73.
Currently, people are taking 73 days.
Yes.
Currently, people are taking 73 days. That is currently. Okay. You want them to pay in how many days?
10 days.
So how many days you are saving?
60.
63 days you are saving.
Yes.
Okay. You are saving 63 days.
Yes.
So let's calculate. Just try to do it like the other sum. Now 365 by 63 you do. 365 by 63. So you got the number of periods. Now just try to solve it once.
5.7.
5.7.
Yes.
So let's round it up to 6 only.
6. Yes.
So you'll get the same answer. That if you had done it that method. Now coming back to this method, they are saying 40% of the people will take the discount. So on 20 million, you are giving a 2% discount, but only 40% will take it up. So the total cost to you is 160,000. So what is the cost of giving the discount? 160. How do you calculate? How much discount you will give? 2%. On what? 20 million. How many people will take? 40% will take. So total cost to you is 1,60,000. Clear with this? So the total cost to you is 1,60,000. Now coming to the benefit. What about the benefit? The benefit is a reduction in the receivable balance. What is the benefit? Is a reduction in the receivable balance which will result from a higher cash balance and will reduce your interest cost. So firstly, you will calculate the current level of receivables and the account receivable period. So current level is 4 million. Number of days is 73 days. Next, you will calculate the new level of receivables and the new collection period. Right? What is the new level of receivables and the new collection period? Okay, so if you call the cost of financing, it would be 480, which I had done already. Now new. So what will happen in the new level of receivables, new level of balance? So now what has happened is 40% of the people will pay in 10 days. 60% of the people will still pay in the old 73 days only. So we'll have to first calculate our new receivables. Okay, so let's calculate our new receivable balance. So let's calculate the old one first. Old receivable balance as per people paying within 73 days. So let's calculate that. Write down. Receivable days is equal to RD is equal to receivables by sales revenue into 365. Receivable days is equal to receivables divided by revenue into 365. Okay. Now we want to find the receivables. Receivable days are given 73. Write down 73 is equal to
73
is equal to
Yes, sir.
R divided by
Yes, sir.
R divided by 20
20,
comma 30 comma 30
comma,
3 zeros 20 million
20 million.
20 comma 3 zeros
Yes.
another comma 3 zeros 20 million.
Yes.
Okay, into 365. Okay, so let's see, find out the R balance. What is R?
Sir, 4 lakh,
4 lakhs. Now take 60% of that
60%,
because only 60% people will
2 lakh 40,000.
2,40,000 is your receivable number, part of first receivable. The people who will pay still pay in 73 days only. Now there is a small group of people who will take the discount. So let's calculate the receivable balance there. Same thing you do. 10 is equal to
10 is equal to
R divided by
R divided by
20 million into 365. See how much people are ready to pay in 10 days.
Sir, 5 lakh 47.
Into 40%. Because only 40% people will take up this.
Minus 2 lakh 19,000. No, sir.
2,19,000.
2 lakh 19,178.
2,19,178. Okay, add both. Tell me total receivables.
Sir, 4 lakh 59,178.
It's 26,19,178. See,
Yes.
add these two.
Sir, that 21,917, sir.
You're getting the
40%.
how much are you getting this?
To 21,917.
So one zero is missing somewhere. See?
Sir, that point is missing, sir. That's why.
So when you add this up, the total you should get this.
21,917 plus 2 lakh 40,000.
2,40,000, no, 24 lakhs.
Yes, sir. 24.
This is 24 lakhs here. It's 24 lakhs.
Second.
Okay, you got this amount. And now calculate 12% of this. This is your new receivable balance. Calculate 12% of this.
3 lakh 14,300.
Yeah. But the old receivable, when you were financing, it costed 480,000.
Yes, sir.
Old receivables. New receivable, it is costing 314. So it's better. Right? This is better. 314 is lesser.
Yes.
So you should
Yes.
give the discount. So you're saving how much? 165 you're saving.
Yes.
So what you should do is you should give the discount. What you should do, you should give the discount.
Yes.
Okay, you should
Give the discount.
give the discount. The cost is 160, benefit is 165. Okay, initially we saw the cost of giving the discount was 160,000.
Yes.
Right? 20 million, 2%, 40% will take it. The cost was 160. Okay, here if you look into, here the total benefit is 165 to you.
Yes.
So the cost is lesser than the benefit. Benefit is greater. So discount should be offered. So ultimately you are comparing it with the cost. So the discount should be offered. Okay. The discount should be offered. So this is the two settlement, discount 1 and discount 2. Okay. Let's break it down again. I know it's a big sum. So let's break it down here. Let's make sense of the cost, Shruti. How did we get the cost here? Okay. Yeah, Angeline, how are we getting this cost? 1,60,000. Okay. Okay. You tell me, buddy, how are we getting this cost?
20 million, only 40% are getting benefit of this, sir. 20 million into 40% into discount, we has to be 2%, sir. We calculate 20 million into 40% benefits into 2% discount means we get 1,60,000.
That's the total cost. How do we get total benefit? Total benefit, what we will do, we will see how much when we are financing the old receivable, how much it was costing, financing the new receivables, how much it is costing, what is the benefit. Then we compare the benefit with the cost, we will get whether we should allow or whether we should not allow. Okay, so that is about this. Before that, here we have seen that giving the discount, how much is it costing, and if taking money from bank, how much is it costing. The buy from bank, it's costing 18%, but taking the cost away, it's costing 16%. So 16 and 18, if you compare, it is a beneficial, you should give the discount. Okay. So that is all the sums and the theory that we've finished from the first part. Next, once this is done, we look into invoice discounting and factoring. That is the next set of things that we will pick, and we will close this tomorrow. The invoice discounting and factoring, we will be done with this. It's a very short part of the chapter here, invoice discounting and factoring. And then what we'll do is we will close the payables. So payables is just one or two calculations. That's it. I think we can close this chapter tomorrow and this will be done.